The weakening Aussie dollar could see import prices rise, adding further pressure on the Reserve Bank to keep the official cash rate on hold at 4.35% at its February board meeting. It's not great for travellers either heading overseas. Joining me is Chief Investment Officer at the Motley, Scott Phillips. Scott, the Aussie dollar under serious pressure. What's going on here?
Kenny, good morning. It really is, most specifically, by the way, against the US dollar. This can be perhaps more appropriately described as US dollar strength rather than Aussie dollar weakness. Either way, though, the exchange rate is the exchange rate, just over 61.5 US cents this morning. It does come down to a few things, mate. We've got a really strong US vibe, I suppose, literally calling it that pre-election. The expectations of what Donald Trump will do as president has seen a lot of companies and a lot of investors investing in US dollars, either locally, local investors in the US bringing their money home, or our other overseas investors throwing money into the US for that opportunity. That pushes the US dollar up and brings the Aussie dollar down. We've also got interest rate changes, economic growth differentials, and of course, the fact the Australian dollar is seen as a bit of a play on China. And concerns about the Chinese economy and their demand for commodities is pushing our dollar down. As you rightly say, the big risk is inflation. Everything that comes into Australia, particularly denominated in US dollars, and of course oil is the big one here, are going to be more expensive as a result. That's a hard one to get around, unfortunately, and the impact is that we will see prices rise on imported goods, particularly those sold in US dollars to Australians. That is not going to be good news for the RBA, as you rightly highlight. The flip side, by the way, don't forget, exporters love it. We get more Australian dollars per US dollar sold. So if you're selling products overseas, commodities or manufactured goods or services, and you can price them in US dollars, it's very, very good for Australia. Plus, of course, good for inbound tourism, and that helps to underpin the strength of our economy as well.
Scott, ratings agency S&P Global has warned union demands for large pay rises in the public sector risks punching unrealistic holes in the state government budgets. What can you tell us?
Yeah, both inflation and the size of the state debts. Now, state and territory debt, on some estimations, in total at least, are going to rival the federal government debt at some point. And we rightly spend a lot of time talking about the federal government, the federal budget, the federal deficit and debt under either party, and that's absolutely appropriate. But if the state and territory numbers kind of get up to that level, we're going to have to start bracketing the two together, because the total debt owed by governments, plural, is going to impact everything right across the country: interest rates, exchange rates, the whole lot. Frankly, the budget opportunities and positions of those governments to provide the goods and services, and of course to impact us with tax increases or decreases. So it's really, really important. But S&P is saying, look, it's already pretty ordinary if we end up with more wage rises across the public service, particularly in states and territories. We simply don't have the funding to support that. That means higher deficits. It means more state and territory debt. And as I said, getting up towards the same level as the federal government, at least that's forecast, over the next 5 to 6 years. Something we need to pay a lot more attention to. The feds don't have control over it, but we are all going to be impacted by it if that continues to happen.
Scott Phillips, appreciate it as always. Thanks so much.